My next guest says those rising bond yields are increasing the likelihood of a recession, possibly as soon as the fourth quarter. But she warns the worst thing the Fed can do is stimulate further. Let's bring in Nancy Lazar, chief global economist at Piper Sandler. Great to have you here, Nancy. Welcome.
Hi, thanks for asking.
So we're kind of like, I don't want to jump ahead, but I do like that little tease. So talk first of all about what is the risk from higher bond yields here? Because right now everyone seems to think, the economy can clearly handle it. You know, Atlanta Fed says GDP is going to be, 13% this quarter or whatever the number is now.
Yeah, it's pretty high. I just think that you have a curse of the leading indicators. It's not just bond yields. The Fed has obviously tightened very aggressively, and bond yields are increasing. You've had the biggest increase in the 10-year yield on a 3-year basis since the early 1980s. So we've had a very, very significant increase in yields. But because the economy hasn't hit a wall yet, there's a general perception that therefore it won't slow. But we do a lot of modeling. We just look at a lot of data. And our bottom line is it's the lagged effects of both the Fed raising rates dramatically and mortgage rates, Treasury yields now also increasing significantly again. They will further slow economic activity. Oh, that's a key point. We have already seen a slowdown in the economy. Why has the PMI dropped clearly below 50? Why have employment gains slowed? Why has GDP slowed? Because the lagged effects of the Fed tightening cycle is starting to creep into the economy, and our work tells us the bullseye will be the fourth quarter and/or into the first quarter of 2024. But for now, we're sticking with the fourth quarter as far as when the recession will start. And then you have to add to that, banks are tightening lending standards very aggressively. It always works. But again, the currents of the leading indicators, there's a view that it hasn't hit the economy yet, and therefore it won't.
As opposed to therefore, well, not that you're in the business of giving investment advice, Nancy, but under your quite plausible scenario here, you'd think, well, this doesn't feel like a scenario day by day in which yields would be pushing to new highs. So what do you think that's all about?
Well, Steve, I was surprised you didn't mention some of these huge wage increases that we've been seeing out of many of the unions that we're getting from the airlines, starting back actually with the rail workers last fall, the airline industry that were on the cusp of potential very, very tough negotiations with the UAW. They're asking for 40% increase over 4 years, 10%. I started in the business when you were finally obviously killing inflation in the early 1980s. I've never seen a wage increases as much as we've seen. And there's like a contagion. Federal Express pilots rejected a 30% pay increase over 4 years because of the UAL and American Airline wage settlements. So I think sticky inflation is not appreciated as also another reason why bond yields have moved higher. And now mortgage rates are clearly over 7%, and housing is going to have another tumble.
It's almost like we should start having you guys predict the misery index, because under Nancy's forecast, we have both rising unemployment and rising inflation, Steve, which is not a very pretty scenario. And so there's at least 3 or 4 plausible different paths people can lay out here. And I'm just curious, her points about wages are well taken. The wage data obviously is probably the most closely followed data set if people try to figure out what the long-term inflation pace will settle out to be.
Yeah, I mean, Nancy's idea here, Nancy's idea here is the scenario that really incorporates the idea of lags to the economy, which is that we haven't seen the effects yet. I will say there's another side to this which has suggested that the lags in the economy are lessened now than they used to be, and we've seen a lot of it already. There are guys on the Fed who believes that, guys like Governor Chris Waller, who say it's in the market, it's in the economy already. I will sort of counter that and side a little bit more with Nancy, which is that as these rates rise and pervade the economy, it feels more and more like there's less place to hide. It was one thing when you had like a 6 or a 7% mortgage rate, or a 5 or 6% mortgage rate. Now that there's 7, there's like you can't call up another bank and find a somewhat lower rate someplace. That seems to be more pervasive right now. I have no doubt that there are drags, but I will say on the other side of that, I would say we've had very low unemployment, and there will be an effect on the unemployment rate. I just don't think that in this world where there's such a premium on labor, which is what's driving those wage gains, that you're going to see tremendous increases in unemployment and a recession.